The most promising part of the blockchain industry right now is the decentralized finance, DeFi, market. DeFi Llama data shows that the DeFi market will have almost $200 billion in locked-in liquidity in 2021. If we think of this amount as a starting investment, this market looks like a great place to start a business. Few international companies can be proud of a capitalization like this. But every new market has to go through growing pains. The lack of certified blockchain developers is DeFi's biggest problem. This part of the economy is very new, and there aren't many people who use it. Most people have at least heard of DeFi, but they don't know what it is. But there is a lot of speculation about it right away, as there is with every new business idea. Staff training takes a lot longer than it should, especially in fields that require a lot of knowledge, like blockchain and smart contract creation. This means that some project teams will have to give in and hire people with less experience. Because of this problem, there is a greater chance that these projects' code has security flaws. Then we have to deal with the consequences, which include losing user capital. To give you a quick idea of how big the problem is, I can tell you that hackers have messed up about 10% of DeFi's locked liquidity. No one should be surprised that most people would rather not use a banking system that puts their money at such risk. How long ago did DeFi vulnerabilities change? Attacks against DeFi have always been centered on reentrancy. We all remember the famous DAO attack of 2016. Investors lost $150 million, and Ethereum had to go through a hard fork. Since then, many smart contracts have used this flaw to their advantage. Lending protocols use the callback function, which lets smart contracts check that a customer has enough collateral before a loan is given out. Because the whole process happens in one transaction, hackers have found a way to get around these smart contracts and steal their money. When you ask to borrow money, the callback function checks the balance of the collateral to see if it is enough to cover the loan. If it is, the smart contract updates the user's collateral balance. To trick the smart contract, hackers start this process from scratch and then send the callback to the callback function. Because the transaction has not yet reached blockchain completion, the function gives out another loan for the same amount of collateral. Even though the solution to this problem has been around for a while, it still affects a lot of projects. Sometimes, project teams that don't have much experience building smart contracts decide to use the codebase of another open-source DeFi project to deploy their smart contract. Most of the time, they do this with well-known projects that have been audited, have a lot of users, and be built securely. But they might decide to make a few small changes to the code they borrowed to add the functionality they want to their smart contract without changing the original code at all. This can break the smart contract's logic, which is something that developers often don't notice. Because of this, hackers were able to steal $19 million from Cream Finance in August 2021. The smart contract made by the Cream Finance team has a callback token and code taken from another DeFi protocol. The checks, effects, interactions, architecture, which puts the change of balance above the issue of money, can be used to stop reentrancy attacks, but some teams still don't protect their platforms against these flaws. Since the DeFi boom of 2020, flash loan attacks have become more and more common. These attacks let hackers steal money differently. The main idea behind flash loan attacks is that since the loan is taken out and paid back in a single transaction, financial parity is still maintained even if you don't have any collateral to borrow money from a protocol. And it won't happen if you don't pay back the loan plus interest all at once. Flash loan attacks, on the other hand, have been used successfully against many protocols. They use a variety of protocols to borrow and drag liquidity until the final act, when they use oracles or liquidity pools to boost the price of a token and use it to pull off a pump and dump and disappear with liquidity in several major cryptocurrencies like Ether, ETH, Wrapped Bitcoin, WBTC, and others. Two well-known flash loan attacks are the Pancake Bunny attack, in which the protocol lost $200 million, and the Cream Finance attack, in which more than $100 million was stolen. How can I keep myself safe from DeFi's tricks? In an ideal world, you should only trust experienced blockchain developers to set up a safe DeFi protocol. They should have a team leader who is qualified and has experience making decentralized apps. Also, it's smart to remember to use safe code libraries when you're making something. There are times when it may be safer to use libraries with older codebases than those with more recent ones. Testing is another important step that must be taken by all serious DeFi projects. As the CEO of a company that audits smart contracts, I always try to cover all of my clients' code and stress how important it is that the private keys needed to access features of smart contracts with restricted access are protected in a decentralized way. To stop one person or group from having full control over the contract, it is best to use multi-signature decentralization of the public key. How do I stop DeFi hackers? DeFi cyberattacks should be avoided, especially because they could cost a lot of money. The DeFi sector has already lost $3 billion because of hacks that can't be fixed. Since this is the case, DeFi protocols have strong financial and reputational reasons to improve their DeFi security. Hacken offers security services to DeFi users like smart contract security audits, penetration tests, and bug bounties. Smart contracts for DeFi need to be checked for safety. The best way to fix security flaws in DeFi is to do a DeFi security audit. A contract security audit is an evaluation of the transactions that were added to a blockchain ledger. Hacken checks the blockchain protocols and smart contracts for networks like Ethereum, Solana, BSC, Polygon, and more. Hacken has looked at smart contracts in Ethereum, which has a market cap of $100 billion, and found that they work well. Hacken is the clear market leader in blockchain audit because we've been doing this for years and our security experts know a lot about it. Penetration tests for DeFi. Hacken offers services for testing networks, mobile apps, and web applications for vulnerabilities. Penetration testing is a practical and inexpensive way to test DeFi protocols. It can help companies that don't have big security teams. A reward for bugs in DeFi. Hacken Proof is a network for bug bounties and vulnerability coordination. It connects users, like the owners of the DeFi protocol, with a community of outside security experts, also called ethical hackers. Hacken has 3 different bug bounty schemes that depend on what the customer wants. Bug bounties are one way that crowdsourcing is used. Dozens of white hat hackers compete to find a certain security flaw first and get paid for it. White hat hackers act realistically, so bug bounty programs are a good way to figure out how secure DeFi is. White hat hackers who use Hacken Proof to report security holes have made 5,730 reports. In the end, education is one of the things that will make blockchain-based financial systems safer and more reliable. Education should be one of the top priorities for people looking for work in DeFi because it can offer tasty benefits to everyone who can make a useful contribution. Don't forget to subscribe to our channel.